video. Today we talk about cash management products and services. Cash management services or cash management products are intended to help the corporates to streamline their cash flow, which means manage the liquidity, reduce the operational costs, and increase the financial efficiency. So this is a bundle. It goes a bouquet. It goes as a payment services, collection services, liquidity management, and treasury management solutions. What are the key objectives? The key objective of a cash management product or a service offered by a bank to a corporate or availed by any corporate is to improve efficiency. That is to streamline the processes of payments and collections and improve the liquidity management. The second objective is security. That is, all transactions are compliant with the relevant regulations. The third is client satisfaction. That means the bank tries to give high quality, accessible service, and the buyer or a seller tries to give the best way of collecting or remitting the payment due from or due to the counterparty. Then comes the regulatory compliance. At all times, cash management products, the collection service and the payment service is expected to provide adequate control to ensure complete adherence to the applicable laws. When we say applicable laws, it could be the KYC angle, it could be the anti-money laundering angle, it could be the FATCA angle. So these products and services, the cash products and services and the payment products and services are expected to meet these minimum 4 objectives of efficiency, security, client satisfaction, and compliance. Looking at the scope of the offerings, the cash services or the payment services, we have 4 buckets into which we put these products. One is a treasury management, the cash flow forecast and the FX solutions, the foreign exchange fluctuation rates. Next is the liquidity management. You may have a little excess cash where we will have to place it for earning some interest, or you may have a small shortfall in cash where you will have to borrow at a small interest. The collection services, that's a lockbox or a direct debit or automated clearing house or a point of sale solutions or an e-commerce payment or a payment gateway, etc. And then comes the payment services. Payment could be cross-border trade or electronic funds transfer or checks or bulk payments or salary payments or multi-bill pays or corporate cards, of which the most complex would be the cash flow forecasting and the foreign exchange hedging solutions. Now let us have a look at general guidelines on how certain things happen. What a corporate should look for from another corporate, or what a corporate can expect the bank to ask, or what the bank expects from a corporate is what we will discuss in this general operational guidelines. One is the KYC part. All corporate clients must complete the KYC of their counterparties and they have to provide their own KYCs to the bank to meet the regulatory requirements. Corporate clients must also submit documentation like where they are registered, what is their legal entity identifier, what is their legal name, what is the validity of their operational permissions, etc. Now comes the service customization. Different corporates can ask for different levels or different types or different range of the services from the payment solutions or the cash solutions. The corporate client's need will have to be separately assessed by the bank because not every corporate has the same requirement. So there is a need for customization of the payment services or the collection services, the frequency, the limits, the preferred methods, the channels, etc. While implementing internet banking solution or an open banking or a host to host or a Swift direct network or API banking, the bank will also provide not only the tools and techniques but also training on how to use these services for the betterment of the corporate so that the full efficiency is availed by the corporate. Transaction processing. Initiation of a transaction. The clients will initiate transactions after ensuring the counterparty are properly screened and cleaned. Then the payments might go through automated clearing house or through any other gateways designated for the local situation. In any transaction, whether it is a host-to-host or an simple internet banking or an approval from ERP directly to the bank via API, the maker-checker concept or the authorization hierarchy or the mandates as per the board resolution of the corporate needs to be followed, and this control, whether it is a 4i principle, 6i principle or other methods, will have to be always ensured at the corporate end to ensure there is no fraud or misuse of the corporate funds. The bank will try to process the transaction on time, but the corporate should be aware of the local clearinghouse cutoff times. For example, high value clearing may have a certain cutoff for the checks. For electronic funds transfer, there could be another cutoff. And then when you have a real-time gross settlement for very high values, there could be a different cutoff. And then we will be, once we are aware as to when the credit could be expected by the counterparty, it will be easy for us to manage the expectations. Otherwise, the T plus 0 or T plus 1 or T plus 2, if there is no clarity, there could be confusion and disruptions. Payment services, as we have seen, are the bulk payments, electronic funds transfer and cross-border payments. And the collection services are lockbox services or ACH. ACH is the automated clearinghouse. Collections or the point of sale, e-commerce gateways and open banking, etc. The liquidity management solutions are the sweeping and zero balance account. When you have a zero balance account, some banks will also have a virtual accounts where the funds will be swept at the end of the day by way of a standing order, and all the funds will be moved to a particular account where it will always remain in credit balance, and so it could earn some overnight interest for the balances. That's the best way to manage the liquidity instead of having small balances in different accounts, which is difficult to manage. The investment solutions are the funds could be placed in tied call account or term deposits, which could earn higher interest. It could also be placed in the money market instruments. The process of investment is little complex compared to normal current account or a collection account. The bank will recommend the corporate to go in for an appropriate solution based on the customer preferences or the customer risk attitude or the liquidity approach. Now let us look at the treasury management solutions. The treasury management solutions are cash flow forecasting and hedging solutions. These are little complex because we need to have a full idea about the past trend and patterns and the future inflows and outflows, based on historical as well as the inputs provided by the client. The bank will try to forecast or estimate the cash requirement at different points in time. Based on this, the customer can arrange for either investment of the short-term excess cash or borrowing for the short-term shortfalls. Hedging is to take care of the fluctuation in the currency rate movement in the future. Compliance and reporting is a very important aspect when you are dealing with cash, because other than lending and borrowing, everything else that you do is with another counterparty involved and it is going through the bank. The bank will be using, for example, if it is a dollar transaction, a dollar correspondent in New York, and the dollar correspondent is subject to the OFAC and other international sanctions and rules and guidances. So even if the transaction is between two countries within Asia or within Africa, because the dollar payment goes through New York and comes back, all these transactions are automatically governed by the regulations that applies to the currency or the transaction or the banks in New York. So accordingly, the compliance requirements or the reporting requirements for any cross-border transaction is very important, because without that there is a risk of funds being confiscated by the regulators. So transaction will be screened by the bank, but it is better for the corporate to have an idea about the counterparty. So that is where the KYCC, the due diligence, the credit report on the counterparty, the background check before entering into a contract, all that comes into picture. Then comes the reporting. Reporting is banks will have to report certain transactions to the regulator. Banks will have to report certain suspicions by raising a STR to the FIU, Financial Intelligence Unit. So corporate should be aware of the risk of doing transaction with an unknown or a shady counterparty. So the clients will receive reports on what transactions are happening, but clients will have no idea about what regulatory aspects are being looked at into these transactions by the various governments. So accordingly, it is in the interest of every corporate to ensure that they deal only with counterparties who are having satisfactory risk grading from an AML angle, from a KYC angle and other things, because all transactions are subject to monitoring to prevent money laundering, to prevent terrorism financing, etc. So the corporate should draw up an integrated cash management strategy, and they can work with their banks. The buyer, the seller, the bank, all of them are affected by the payment services, collection services, liquidity management and treasury management services offered or not offered by their banks. And if proper cash management solutions are not availed by the customer, then there is a risk of not having enough efficiency or not having a proper cash management strategy within the corporate. So the banks will try to understand the client needs, for which the client will have to help with the previous information, the future plans for the cash inflows and outflows. Also, to ensure compliance, we need information about what the transaction is and how it is being done and what is the background. When bank is implementing certain key services to the corporate, the bank will try to provide training, but it is for the company and the corporate to understand the requirements of certain features and certain functionalities of the application, be it host to host, be it an internet banking, be it API, so that the transactions flow smoothly. Optimizing performance is one of the key, because continuous monitoring, measuring of the output, measuring of the expected results, if it is not done, then it will remain static and there will be no room for further improvement in the efficiency. So in the cash management, the expectation is that there will be a comprehensive strategy between the bank and the corporate to ensure that the guidelines are followed, the efficiency is brought in, transactions are secure, and every action, a payment or a collection, is reliable. Thanks for watching this video. We will meet again in another session on transaction banking services.